take my mask off, feel good up here, enjoying this. There. First of all, Happy New Year. I've had the privilege of attending a couple of BRAG meetings. Reinhart and Frank McVeigh and Pat Durston and quite a few other people are regular attendees, and we're really pleased to be able to present to this group. I've been with Reinhart, if you know me at all, for about 24 years. I manage the Reinhart North office. And as of yesterday, we'll be transitioning into the general manager position at Reinhart over the course of the next year or so. It's a long-term transition. We have a legacy of people at Reinhart not retiring, but staying on to help. It's a wonderful thing. So I'm pleased to talk a little bit this morning. What do I want to say first? I've got great news. The forecast for 2022 is pretty similar to 2021 in terms of activity and business. In spite of the pandemic and the surge and some inflation and some supply chain issues and a slight uptick in interest rates, demand remains strong for new builds, remodeling, and resale of homes. We're happy about it, and we're wondering, why is this the case? I mean, we figured it was time. Everybody's saying, is the market going to crash? Is it going to change? Are we heading into a recession? All the experts, including the local experts, say no, that's not going to happen. Part of that has to do with, don't look at my slides yet, because I'll get to those in a minute. The inventory of existing homes remains low. We just don't have enough homes to sell. Those of you who are building know that you are selling things as soon as they're available, pretty much. We've got all sorts of people looking for housing right now. Who are they? Primarily millennials. They have been waiting to buy homes. They've been locked out of some of the home inventory over the past couple of years. COVID has exacerbated their need for space and for a great place to live, and that demand continues. The inventory of existing homes is extremely low, still a seller's market at most of the price points, but I'm not going to go into that too much because I'm guessing my cohort down here is going to talk a lot about the niche of what's out there and what the absorption rates and all that other good stuff is. So what I will say is it remains robust in all but the really high price points. And those fly off the market if they're in move-in and updated condition. We'll talk a little bit about that in a second. Interest rates, the lenders have made it really easy for people to get loans. There's lots of programs available. We still have zero down programs for modest buyers, and yet we have expanding caps on FHA and some of the other products. So it's never been easier if you have decent credit to get a loan. And what do I want to say next? The reason that I think the market also continues to be good is that rental rates are continuing to rise. If you look at what's happened at rentals of single-family homes or condominiums in the last year, the price rate hike has been astronomical. Part of this is because in the beginning phases of COVID, they couldn't raise things and they couldn't evict people. But after the forbearance period kind of has weaned and passed, there's been a huge demand for single-family and condominium housing. And so investors are in the market to make purchases in addition to all of the millennials and all of the boomers wishing to switch homes. And so that continues to drive our market. Boomers are not moving like we thought they would. I'm a boomer. I'm 61. I'm on the tail end kind of the boomer thing, and I have no plans to move for the next 20 years. What does that mean? It means my 4-bedroom, 2.5-bath colonial is not going to turn over to somebody who needs more room, isn't it? I don't want to move. Moving's a hassle. Am I going to remodel? Yes, you'll all see me. That's because I'm in the business, and I got to tell you, most boomers are also not doing major remodels. What they're doing are some adaptive remodels, and they're making sure that their infrastructure is good. So roofs and furnaces and all of those things that are integral to the integrity of the housing structure. Windows probably as well are all being done. but the big glamour bath or kitchen is probably not gonna be done by someone in their 70s, right? They're just interested in having a nice, comfortable place to stay. They don't wanna move for a variety of reasons. First of all, most of them have decided that they would like to make one move, not several moves. It used to be you had the big house, you downsized, you lived there until you couldn't live by yourself anymore, and then you moved into an assisted living type situation, right? Nowadays, we see people who say, I don't wanna have to move twice. I don't wanna have to get rid of all this stuff. What I'm gonna do is I'm gonna live here in place for a while, and then when I move into assisted living, my family can worry about all my stuff and the house and everything else. And we're seeing that in our market. And so this too has put a pressure on the demand for housing for all of those people that are looking, because we're just not seeing those people move. Lastly, boomers want ranches, they want no maintenance, so a lot of times condominiums, and there's just not enough of that product in terms of space requirements to satisfy them, because they're used to living with some space, right? They're in homes right now, they're used to the privacy, they're used to the garage, they're used to all of these things, and they're just not finding those products easily at a price point that makes sense for them. Because most of them don't want to spend more money than the house that they're leaving is worth, all right? Other things that we're seeing, as I mentioned, boomers are doing remodeling. They're certainly widening showers and doing things to make aging in place appropriate. We're seeing people who have colonials that have a living room, dining room, family room, kitchen, taking the dining room and the living room and converting that, backing it up to a half bath and doing a master, so they can just live on the first floor, and then they can have somebody who's living with them maybe upstairs, or even, you know, basically close off the upstairs if they're in an area that they like. And one of the reasons this is happening is when boomers bought their homes, that home represented kind of their status or their badge of honor when they reached a certain level of their career or job. So moving into that nice house, that bigger house, is not just moving into a structure. It represents something, and it's really hard for them to give that up. That make sense? Yeah, they worked a lifetime maybe to be able to afford that home in Ann Arbor Hills, or maybe it was in Glacier Highlands, or more modestly, it might have been in a smokeler subdivision along, you know, it was the pinnacle of their life when they moved into that house, and they're just not ready to give that up yet. So because of this, once again, we're seeing problems with millennials getting housing stock. And the other thing about millennials is they're picky. I have two of them. They know what they want, right? I had 2 kids buy homes last year. They both bought new or almost new. They wouldn't look at anything that had to be fixed up, because who's doing the fixer-upping? The flippers, the investors, and the baby boomers' family, if it makes sense when they get ready to sell, right? But most millennials, they don't want to go through the pain. They just want to walk in and live. Now that's most, that's not all. I'm not downing millennials. I love mine. They're awesome. But man, I wouldn't want to be their realtor. Fortunately, they were out of town. What else do I want to say about demand? I think the craziness that we saw in 2021 with pricing, because of demand, is going to be tempered this year. All the experts say it's going to be tempered. I actually have these slides. I should probably use them. First of all, I'm not going to talk a lot about this because you're probably going to talk a little bit about interest rates, aren't you?
A little bit.
So what I will tell you is we in the real estate industry are not expecting interest rates to rise much, because we believe the experts that say a percentage point or less this year is probably anticipated, okay? And historically, the rates are still really good. And for most people, it's not going to make a difference whether they buy or not. So I'll be honest, that's favorable for all of us. Home sales are projected to be strong, but not as strong as they've been. And part of that is because, once again, we have some supply issues, and we also, we've got some other mitigating factors in there. We're seeing a lot of generational transfers of homes. I'm a good example again, let me use myself. I could not get my dad to move. My dad is 85. Took me 3 years of talking to get him to move. You know why he moved? I agreed to buy his house. That's the only way he would move. That's why I'm living in a 4-bedroom colonial with 2.5 baths. He's still alive, I cannot sell. I'm not the best example, but I do have examples in my family that mirror this. We project home sales this year are gonna be just about as strong as they were last year, but prices, instead of rising into double digits in terms of appreciation, we believe appreciation is gonna settle somewhere between 3 and 5% locally. Now, will there be homes that appreciate more than that? You bet. There's niche markets here in the Ann Arbor area, in Washtenaw County that are gonna go, because they're unique, or they've got an unbelievable site, or they're done to the nines or whatever. But we believe demand will continue to be good, home pricing will rise gradually, and that we won't see as much in the way of multiple offers, because people who have been looking and haven't gotten a house yet, they're sick of these bidding wars and these multiple offers. They're gonna scale back a little bit, and even though demand is strong and there's a lot of people that need housing, I don't think we're gonna see as many crazy multiple offers as we did last year. Okay? What else do I need to say? I kind of went off my notes and then went crazy. Let's see what other slide I have here for you. Yeah, home price forecast. And this is what the experts say. Experts are saying what? 2.8? Is that what they're saying? Now medium is what, 5? I think we'll be just under that, to be honest, with most of our homes. Demand for new construction, fabulous. If you're building right now, good for you. I know you're dealing with supply chain issues and you're dealing with the cost of labor and everything else, but we love you. We've sold a lot of new construction in the last year. We have a lot of pending new construction for this year. It's gonna be a great year for building. If you can get things up, we will get them sold, okay? And in terms of remodeling, oh my gosh, we need you. We need you badly, and we project it's gonna be a great year for remodeling. And that's all I have. Questions?
When do you want to work on your house?
Now. I know it's gonna be 6 months before someone touches it, but I'm trying to get my plan together for sure. Anything else? Yes.
How are the raising house prices doing with the raising or not raising of wages?
Well, that's a very good question. I mean, most wages have increased, obviously, in the past year, but we do have an inflation factor going on, and I don't have a lot to say about that. Do you?
We'll talk about it. Yep.
See? I love it. We got experts here.
You know, you talked about, investor groups, which, that has been around for a long time, flipping, but I get a sense that it's much more strategic, and we're seeing outside, almost basically venture capitalist groups coming in and buying in communities, particularly condo communities, where normally you wouldn't see maybe half a dozen or less investment properties in a given year. But now it's like almost every other month they're coming in paying cash. And how do we do it as condo associations and some of the issues with the rental caps and things like that? What are you guys seeing with that?
Well, I will tell you, we are seeing what I would call less novice investors and a lot more what I would call professional investors. We definitely have seen that in our market. And we're seeing it not only in condominiums, but in neighborhoods of single family homes, where it seems like they strategically decided we're gonna control a large section of this market. Their algorithms or whatever are telling them this is where they wanna be. I don't have a good answer for that. I really don't. What I will say is I do think, because we all, or many of us lived through the recession, that it's probably not a bad idea to have a limit on rentals if you're a condominium association. It's probably, you shouldn't lock them out. I don't think that's a good idea, but I think there should be limits. And we're seeing a lot of associations who have tacked on additional association fees for rentals. But I don't have a good answer. I do know that we have some major groups that are in the area buying, and they're from out of the area. And they're not necessarily foreign investors. They're United States investors, but they're groups from out of town. A lot of people from California, a lot of people from New York. The coasts are doing some investing here. So, I think I heard yesterday on the news that Michigan is the state that's 6th for moving out. but that represents an opportunity for moving in, right? So it really doesn't surprise me that we're seeing more investors in our area. And the financing is interesting for those groups. I mean, I saw a deal the other day that had this piece of paper, and I've seen hard money and soft money loan paperwork, but man, I was like, what is this? And my clients went with a conventional loan that was local because they were just for a little less money because they didn't like the terms. So it is interesting. Cash though is they come with a cash deal, hard to turn that down if it's a good one. Yes.
Can a builder or a homeowner say that he won't sell to an investment group, he wishes to sell to an individual? Is that possible?
Well, that's a good question. So I think you'd have to be careful. Is the investment group ethnic? Could it be a fair housing violation? You know, I think that's like selling to, how do you know who's gonna end up being an owner occupant? They may say they're gonna be when they're buying, but are they gonna actually be? People love to sell to families. We can't let them do that. But we can't encourage that decision making because that's against the law. So, good question. I don't know that I have an answer.
But doesn't it kind of speak to what you said about your client that said, hey, look, I saw this one offer even though it was more.
It was financing. They objected to the financing. Had it been a cash offer, they probably would have taken that deal.
Oh, okay.
But it was the financing that had them nervous. It said closing within 20 days of escrow. It said there were all these things on the pre-approval that really didn't look pre-approved. It looked more pre-qualified. It was an out-of-state lender. We couldn't get a hold of the lender easily on the phone. I don't know about you guys, but local's great. If I can come sit on your desk, I love you, because I can get things done. But if you're in another state or you're across the state, it's much harder to facilitate a problem or a solution, right? Yes?
If, just a question, if inventory is still really low and you expect demand to be high again in 2022, I'm not quite understanding why you think prices are only gonna go up 5%.
Well, we've got inflation, we've got the virus, and the stock market has been somewhat volatile, right? And there's still a lot of uncertainty in the market, and we've been going at such a huge pace for so long that some people are basically saying, I'm not willing to pay 20% more or 18% more or 15% more than I did last year. Will there be some new construction that does that? Probably, because that trumps everything. Brand new, we love it. It's shiny, we move in, great. But everything else, and you'll talk a little bit about appraisals. If you're financing, you may have to come out of your pocket with that difference. And I think people have less cash, some of them, than they did last year. They've spent it. So I think I better sit down because I could be here a long time. So thank you for having me.
Good morning, Kurt Schmerberg with Affinity Valuation, and Pete's going to get my presentation up here shortly. You're going to see some commonalities, at least initially, between, I just knocked that up, between Nancy's presentation and mine, because we pirated from the same source. I did anyway, she probably paid for it. But Affinity Valuation Group, just in short, we're a real estate appraisal firm that does business primarily in southeastern Michigan. With the exception of Monroe County. We don't have anybody in Monroe County right now, but essentially southeastern Michigan, we do residential and commercial appraisal work, including vacant land, farms, and whatnot. Again, you can see the commonality of the colors here. These are, I'm going to start by talking about the national side of things, and then we'll get more into the local stuff as we go forward. Mortgage rates are projected to increase slightly. And as Nancy said, about the 1% to 2% rate is what we're saying. The Fed has said that they're going to adjust interest rates twice this year. I'm thinking we're going to see that rate bump sometime in the spring and then maybe again in the fall, depending on where inflation is and how it works through the system this year. So we do expect mortgage interest rates to increase. As Nancy said, I don't think they're going to increase beyond that 2% rate, which is not going to shut the typical buyers out of the marketplace. Home price forecast, that's the same slide that Nancy just showed you. Again, this is nationally, they're projecting, and across the bottom there are the different groups that were surveyed. Freddie Mac, Fannie Mae, Freddie Mac, the Mortgage Bankers Association, and then NAR, which is the National Association of Realtors, surprisingly has the lowest estimate for price increase. But the average is about 5.1%. And that again that's the national range, just so you know that I think when we get into some of the local things, you'll see that that is going to be a little bit higher locally than it will be nationally. Home sales projected to be strong, absolutely. Again, that gets back to some of the things that Nancy mentioned with respect to inventory shortages, things being lower, and all pretty much, again, across the board. These were the folks that were surveyed, and they're all projecting a sales increase, the number of sales. This is one thing that we take a look at because this is more southeastern Michigan specific. This is annual light vehicle sales. This is car sales. On the far left is January of 19. Here we were at about, I think 17 million car sales. When you get down, where's my word? Right in here, that was the low point in May of 20. That's the height of the pandemic. And then things increased, and then we saw a real spike about the middle of last year, and then they've dropped back off again now with the projection going back up. Most of this drop off is due to supply chain problems, not due to demand for vehicles. Vehicles has remained relatively strong. I accidentally pushed the button. Unemployment rate. We're looking again nationally. The folks are saying unemployment is going down. That doesn't account for some of the folks who have taken themselves out of the job market, either through retirement or just that they don't want to participate at this point in time because of COVID. But we don't see unemployment being an issue with the home buying market. Consumer price, again, nationally, we're projected to see inflation of about 6.8%. That's going to affect costs for builders, costs for groceries, costs for everything. So there's going to be some competition for folks for their dollars that they can contribute towards housing. So that will have somewhat of the moderating effect that we're talking about with price increases not being able to go to the max. So just to kind of summarize nationally, employment rates stable, auto sales should be returning to normal, which will help southeastern Michigan. Inflation will force some higher mortgage rates, home values will continue modest increases, housing inventory shortages will continue, new home constructions are projected to increase, and wage growth we'll see in most sectors. This data is compiled by our office, using primarily the Ann Arbor Board of Realtors information. I always like to acknowledge them because we share all of our data back and forth with the Board of Realtors, and we're happy to share that with this group as well. This was hot off the press. This is the trend in average sale price in Washtenaw County. On the left, for those people in the back, is 2017. The average sale price in Washtenaw County was $311,000. If you go all the way far to the right, 2021 was $404. So you see the increase has been consistent in Washtenaw County. And if you look across the bottom in the yellow bars, those are the actual number of transactions that have taken place. 2017 was 3,847 sales, dropped slightly in 2018. Again in 2019 it dropped, stabilized in 2020, and then it was back up in 2021. This is a graph that we use religiously in our appraisal reports because they travel nationwide, because we don't know where the lender sells that loan to. This is just a snapshot so that those folks out in California can see that even through the COVID problems, we've continued to see price increases here in Washtenaw County, consistent. This is the average sale price in Washtenaw County for the condominium market. That first slide was just single-family residential, detached. These are attached condominiums. Same basic pattern, with the exception of 2019 and 2020, we saw a leveling effect, just a slight increase between those two. Then across the bottom, again, the number of condominium sales has been fairly consistent at around 1,000 units per year. We don't see any changes in those going forward. This is what Nancy was talking about when we talk about demand. The far left, for those of you in the back, is, let me title the graph. It's the days on market, average days on market for properties in Washington County. In 2016 was 57 days, in 2021 was 26 days. So there's, properties are staying on the market about half as long as they did 6 years ago. Inventory is turning over very quickly. Average sale price by school district in Washington County. On the far left is Ann Arbor, with here being the 2020 rate and 2021. And again, it goes Ann Arbor, Chelsea, Dexter, Manchester, Milan, Saline, Whitmore, Lake, and Ypsilanti. And I'm pushing buttons. I'm sorry. Fat fingers. With not enough coffee. Again, you'll see that in every instance on the micro level of Ann Arbor, Chelsea, Dexter, all of the sales, average sale prices are up in each one of these school districts. So it's not only a county increase, it's filtering down onto the individual school district level as well. This is the same graph, only for condominium only. You'll see consistently there, with the exception of Milan being kind of flat and Ypsilanti being somewhat flat, the average sale prices for condominium dwellings are up year over year as well. This is interesting for our folks that do energy efficient construction. We get this question every year. I've done this panel for you folks for a number of years, and the question is, how do you appraisers measure energy efficiency and the effect on value? And it's difficult. It's very difficult for us. We're finally now getting some information that we can use in our appraisal reports to justify increase in value. Just to kind of give you, this is 2019, the average sale price per square foot of any house that was identified in the multiple listing service as having a energy certification. That could be a HERS, a LEEDS, tell me what some of the other ones are, I forget what but the certification, if they indicated it was certified in some way as energy efficient, the sale price per square foot for those dwellings was $192 in 2019, took a small dip, $189, and now in 2021 was $2,002. The problem that we have, as you can see, is the number of observations is really low. 34 in 2019, 26 in 2020, and only 47 in 2021. It's a shortage of data for us. So if we take a look at this number, 207 or 2? I can't see from my $207 per square foot for energy efficient homes. And this is the average sale price per square foot for everything in the county, 210. It's hard to make an adjustment for energy efficiency when this is the kind of data that we get now. This is 3,800 sales versus 47 sales in the last. So we're trying to refine that data for you and get that for you, but right now this is the kind of stuff that we get, and that's because there really aren't enough sales being identified in the multiple listing services to give us the data that we need to crunch those numbers and make an accurate assessment of what those are. So just to kind of summarize, unemployment rates should stabilize and go down actually in Washington County. We're going to see some slightly higher mortgage rates. Home values will continue to increase modestly. There'll be some inventory shortages for sure. New construction, please build, okay? Because that's the only way we're going to work out of some of these dramatic changes in the market, is to get some supply. An increase in wage growth, which I think that's more of a local thing. We're finding or seeing competition for employment to be very strong here, and so there's folks paying sign-on bonuses and whatnot, so we're seeing that wage growth should continue. Thank you. Appreciate it. I'll take any questions anybody might have.
Let it go in here.
a very happy New Year to you. I'm going to do more talking than I am slideshowing. Much of what I'll cover today, I think, has been touched upon or hinted at by my colleagues. It's great to see you. It's great to. I'm a first-timer, by the way. Thanks for the invitation from Rick Stites and the team here. It's great to meet you all. I was a former Ann Arbor resident here about 23 years ago. I went to school here. I love this place. It's great to be back. And what a great excuse to travel west on the 5th of January. So my name is David Fischer. I represent Putnam Investments. We're a Boston-based firm with global investment managers around the world in Tokyo, London, China, Singapore. We manage about $200 billion for individual investors primarily in the form of mutual funds and separately managed accounts in all asset classes. And so I've got this privilege of representing this firm across the state of Michigan and Toledo area. And here we are coming into the year. I don't know why this isn't working.
Yeah, I don't know.
I need a power
Send, just to send the signal?
No, it should just pick it up.
All right, well, let's see.
This stuff is not critical, but
All right.
here we are at the first part of the year, and in January, I want to commend you all for being out today. It's great to be in person. I mean, it's been 2 years of doing this thing via the Zoom call, so what a great refreshing start to the year. But I've got 7 requests in the first 2 weeks of January to talk about what we see coming. So I think as we work with financial advisors, our primary clients around the state and the country, we've had this unbelievably weird 2 years. It's been noisy, there's been a lot of bad news, there's been a lot of good news if you want to look at it that way. The economy has been raging, it's been stopped, it's been massively in recovery, and there's a lot of questions and confusion to maybe sort out. I hope today to give you a framework about the year ahead that can maybe help you inform your conversations. I am a huge fan of what you do. I thought about being a contractor before I got into this financial mess. So congratulations to the builders. I know you're in a raging market. My wife and I love to remodel homes. We've done a couple of them. We're kind of real estate side hustle junkies and enjoy it. So it's a great crowd to speak with you. So let me give you 4 ideas about the year ahead in 2022. We'll talk about 2021 a little bit, but I like to keep it simple. There are 4 things that drive financial markets. And maybe real estate, partly this is true as well. There are 4 E's, okay? There's the economy, there's corporate earnings, there's Europe and the emerging markets, that's 2 E's in 1, and then there's how people feel, emotions, okay? Let's talk about all 4 of these in the context of what we see in 2022. The first thing I'd say about the economy, we'll start there, is don't fear a recession. Every meeting I have, the 2 questions are, Fish, what do you guys think about inflation? And is this enough to turn the corner on a recession? We've had this great year theoretically in 2021 coming out of the recovery from that stopped economy. How soon till we hit the next speed bump? Well, let me tell you about 2021. 2021 was the single best economic reporting year in the last 36 years in the United States. We think we're going to come in, we're going to close the year at about 6.5, 6.7% real economic growth. What does that mean? Well, on a $20 trillion economy, that's like $700 billion of new goods and services being created in 2021. We went from about 11% unemployment in the middle of the pandemic down to 4.2 in December. We are near full employment. People will say, well, hey, wait a minute. We got all these people who are quitting. We got all these people who don't come back to the workforce. We got 11 million job openings. That is true. And there are some structural ideas that I'll share with you. We've done some research on this going back a couple hundred years on how the labor market works. But what we're seeing is, yesterday, this just came in while you were talking, Nancy, 800,000 new jobs added in December. So before Omicron took its effect, the corporate sector in the United States added, we think, about 800,000 new jobs. What was the market expecting? 400,000. So you're seeing people starting to get hired, right? We're seeing people leaving their jobs because they can find a better deal, a better fit for their skill set, maybe better wages. We'll talk about wage increases a little bit. That was a question earlier. But the economy last year was raging. And we think this year it continues to grow. There are huge tailwinds in this economy that, as much as the virus wants to sort of put a little bit of a brake pedal on it, continue to sort of set up this idea that we really do not expect any chance of recession. It's not zero, but it's next to that because there's just too many fundamentally good things happening across multiple sectors. You're feeling it in the housing real estate market, right? We see it in the cyclical companies, in the cyclical sectors, think industrials, think financials. These companies are making so much money, they're so profitable, we'll get to that in earnings. But there is meaningful trends that support a continued expansion, just not quite as fast as we saw in 2021. Our expectation for 2022 is we move from a 6.5% real growth rate to a 3.25%, 3.5% real growth rate, okay? To put that in perspective, you think, well, we're growing half as quickly as we did last year, roughly. If I go take you back to 2019 and the 10 years prior, meaning the 10 years following the great financial crisis, we were celebrating 1.9 and 2% real economic growth in the United States. This sort of slow, steady, muddle through economy. Not too much. We weren't really in recession. It was just this kind of stagnant deal. We are not talking about numbers like that. We're still 50, 60% higher for our outlook for 2022. So keep in mind, employment's improving. The economy has got huge tailwinds. We can talk about specifics if you want, but I think the key takeaway for this morning's conversation is that the fundamental economic backdrop continues to support everything that the folks have shared to date and everything that you're doing professionally, both in real estate and building construction and so forth. What are the big hiccups and the risks of the economy? People say it's inflation. And we'd argue, look, this is a risk. I'm going to be the contrarian up here and tell you that research we're seeing in the last 2 to 3 weeks is already starting to very clearly indicate that price peak, inflation peaks may have already happened. We saw an ISM, the Institutes for Supply Management survey yesterday that indicated prices paid at the supplier level, so for goods delivered to suppliers, are falling. Last year at this time, we were watching how commodities were just exploding. Lumber was up 100%. Oil was going from 25 to 75. Here's my point. That stuff's already in. Lumber's come back down to its pre-pandemic average run rate. For those of you that were buying wood, I think you're probably seeing that. If you're not, you're going to see it bleed through shortly. This chip shortage issue on the supply chain is something that certainly affects Southeast Michigan uniquely, right? If you've driven up by Flint Bishop Airport, I was going up to Saginaw a couple weeks ago, and I don't know if you look at that plant, there's the GM plant right there on the east side of 75. The entire lot is covered in unsold pickup trucks, waiting for chips for their heat seaters or their steering wheel seat or whatever it is. I mean, I'm talking thousands and thousands of brand new cars ready to hit the market. We were talking about auto supply or auto sales this year. What's very interesting about that is wait till the chips start to come in and that supply just floods the market. We think the peak, okay, in car pricing, not here quite yet, but likely sees the second half 2022 decline in that increase rate. Let me give you a very interesting statistic about inflation. This was news to me last year, but if you start digging apart and looking at the calculus that makes up the math that the Fed uses to report CPI or core PCE, fancy words for price, producers and price consumption. It's interesting. About 75% of the increase in CPI last year could be attributed to one category, and it's called transportation. Okay, so you look at housing and energy and food. What's transportation? Well, transportation is roughly a 15% weighting to CPI, but it includes new car prices, used car prices, hotel rooms, airline ticket prices, okay? This sort of bigness, rental car rates. This is a 15% contributor to what makes up CPI in the aggregate. That unit last year was 75% explaining the rate increase in the total overall number. And so you think, well, what does this mean for inflation in 2022? Well, those numbers were being compared to 2019 when the economy was shut down. You couldn't buy a car because dealers were closed. You couldn't travel because nobody wanted to get out of their house, right? They were mandated. Nobody was renting hotel rooms. Nobody rented cars. The easy compare between 2019 and 2020, which drove the CPI higher, is through. And we're now beginning in 2022 to see that year-over-year run rate is going to have to decline just because we're coming off 0 to 100%. Now we maybe see a 2 or 3 or 4% increase in, say, airline tickets. We start to see a flood of new cars come back as chips become, implanted, if you will, into those cars. This is going to put downward pressure on inflation. Do we think inflation is, we're not going to a deflationary environment, but what we're seeing here right now, I think the CPI number in December was over 7%. You're already seeing it fall to probably in the 5 half range, and we see this continuing first half. What does that mean for the corporate earnings? Let's get to the second E. Continued incredible growth in earnings for 2022. Not as great as 2021. Earnings grew, we think, about 45% last year. And if you looked at what the street and all this collective group of analysts that spend all their time looking at corporate profit reports and so forth, they kept upping their estimates for total earnings per share for the S&P 500 companies last year. We went from about 140 per share to 185, we think, by the end of the year. That's with our estimates coming into 2021. We think we're going to finish about 185. We expect earnings per share for the S&P in 2022 to grow another 18%, okay? So call it $215 per share. We have fully surpassed the peak earnings rate that existed prior to the pandemic. And we see the next 2 and 3 years that earnings per share continue to likely rise. That's on the heels of moderating, albeit higher than we've been used to in years, inflation. There is a risk that we could be wrong on this, right? You could have another supply chain, you could have another variant that could come in and shut things down again and sort of choke up, if you will, the supply chain and so forth. But we think these bottlenecks are starting to work themselves out. Data is showing us that, and that is actually pushing downward pressure on prices over the last 6 weeks or so at the supplier to producer level, right? That'll bleed through. Does that mean prices are falling? No, but we think the peak is probably in. And inflation likely is less of a freak out scare story than it was last year, okay? I don't think that really is going to affect real estate because the supply-demand imbalance in the housing count that we're seeing is real. And what Nancy was talking about is 100% true. That doesn't work itself out in a quarter or two. It's going to be multiple years before we get that balance of demand and supply back in. That's probably very bullish, frankly, for the housing market, right? So earnings, 2 things on that front as well. We think we're in the cyclical recovery. That's fancy financial speak. What does that mean? That means we are still in probably the middle innings of an economic cycle that began in probably August, September of 2020. So the pandemic hits, everybody shuts down, economy goes to basically zero for all intents and purposes. We spend the summer of 2020 freaking out, locking in, not doing anything, saving money, watching the balance sheet of the consumer get stronger and stronger and stronger. We were getting savings rates in 2020 of like 17 to 30%, depending on the month or quarter you were looking. That is completely unheard of. Well, that's because people couldn't spend their money, right? They couldn't go out and eat, they couldn't really go shopping, they couldn't travel, take vacations. There was a huge pent-up backlog of cash and savings that's been basically a part of the benefit of what we're here to talk about today in housing. But more importantly, that started to work itself off in 2022 as consumers kind of got back after it. But that economic trough, we think, hit bottom in August, late August, early September of 2020. And from that point on, it's been a straight shot up with these record numbers for the economy and so forth. What we're seeing, though, is that when that happens, when the U.S. economy bottoms, okay, certain sectors, from a stock market perspective or a bond market perspective, certain sectors do well coming out of an economic recession. And those are cyclical sectors, companies that are benefiting from a broader economic growth, okay? This is sort of contrarian. What I'm trying to think in English is that value stocks, financials, industrials, consumer staples, consumer discretionary. When the economy gets better, people feel better and start spending discretionary money. These sectors do well coming out of recession. We're in the middle innings where that is still going to be true, we think, in 2022. Flash back to 2019 and that prior period, and what were we talking about? We're talking about the FANG stocks, right? Technology, Facebook, Apple, Netflix, Google, or Alphabet, whatever they want to call it now. The companies that did well for the prior decade were companies that benefited because the economy wasn't growing quickly. So an investor could say, I can go to Apple, doesn't matter if the economy is on fire or if the economy is slow, everybody in this room is going to the Apple store and buy their new iPhone or buy their iPad or something. It's completely insensitive to the bigger economic backdrop, right? So technology and growth stocks are doing really well. That is completely flip-flopped, and we think that trend continues to be reflected in 2022's earnings, quality, and more importantly, performance for the stock market. People were asking about rates. That does affect earnings. It affects, more importantly, valuations of housing, valuations of the stock market, valuation on bonds, if you want to get specific. Here we are at this record low period of rates in the United States. I mean, Fed's been at zero now for about almost 2 years. they've announced over the last couple of meetings that they intend and are beginning to taper their monetary policy that really was designed as an emergency effort to stave off deeper recession from the pandemic. What does that mean, tapering? They're going to slow their purchases of open market bonds, both mortgage bonds, corporate bonds, and U.S. Treasuries. And that's the first step to becoming less, quote unquote, accommodative, to becoming more, shall we say, higher rate prone. I think the opportunity and what we're expecting is the Fed's going to raise rates. Fed funds are going to finish their taper by March when they want to get done. They want to start beginning to raise rates in probably May, and maybe they get 2 rate hikes through calendar 2022. On the margin, that's completely different because they've been in complete accommodative, super dovish mode, right? Let's just throw as much money at the economy as we can. But the economy is telling us already that it's foundationally strong enough not to require the emergency support that the Fed's been giving. So they're starting to wind that down. It's been hugely beneficial for mortgage rates, right? Not only are rates low, but the Fed's been buying mortgage paper, which has kept even maybe an additional sort of depressing, shall we say, pressure on mortgage rates that helps the appreciation in housing. But the story here is the Fed's needing to change tone and tenor. What's interesting is that from an absolute perspective, the cost of capital in the economy, for corporations, for buyers of homes and property, is unbelievably cheap. And even with 2 rate hikes in 2022, if the Fed in fact ends up pulling that off, we go from unbelievably cheap to not quite as unbelievably cheap in terms of the cost of capital. And corporations, if you listen to CEOs and CFOs talk about their outlook on earnings, well, what do you think about the Fed's change in tone and tenor? Not even an issue. These corporations, borrowers, lenders, if you will, can all accommodate this slightly moderating rate. The other interesting thing that we don't think about that much here locally is just how our relative interest rate level in the United States compares to that of the rest of the developed world. At 1.6, 1.7% on the 10-year Treasury, we are still higher than the 10-year bonds of Japan, which is basically 0, Germany, which is negative, England, Europe, most of South America, not the emerging markets per se. But what that means, as our rates continue to rise a little bit, these other sovereign bond issuers and investors overseas are going to find it incredibly attractive to buy our debt. This has happened a number of times over the last couple of decades, but as our rates rise, our bonds become even more attractive to foreign buyers. And what's happened in the last, call it 36 months, is that it's become cheaper to hedge the currency function of, say, a Japanese investor wanting to transition their yen to dollars and then buy US debt. That's become very, very cheap. So you see massive amounts of institutional foreign money come into our treasury market when rates get high. I mean, last March we hit our cycle high of 1.78% on the 10-year. And we've been down to 1.2, 1.1. This last 2020, we're at 1.6. We're getting kind of back to where we were, and we're already starting to see foreign buyers come back in. What that means in simple terms is, you know, could the 10-year get to 2, 2.25? Yes. But there is, in essence, a ceiling of foreign buyers that put on rates, which is going to continue to support, I think, the real estate market, and more importantly, the mortgage market, even as the Fed begins to change their tone and tenor. Okay? Let's talk about Europe and the emerging markets quickly, if that'll be helpful to you. It doesn't really have anything to do with Washington County per se in the housing market here, but in simple terms, this is the tale of 2 stories. Europe, if we're going to grow 3.75% in the U.S., Europe's maybe at 2.5. In aggregate, Europe's got so many interesting political differences. They've got different policies in place. Their economy is inherently more defensive. If you look at what makes up the index, the companies that sit in Europe, you know, Apple is not a European company. Facebook, hugely innovative companies, are not really, many of them are not in Europe. So the index tends to be much more economically sensitive. You think, well, that's great. It's been true. Europe's numbers and the returns of their stock market are good. But they don't have the dynamism and the health of the economy that we do in the United States. And you juxtapose that to emerging markets, 30% of which is China, the rest is India, Mexico, Brazil, South Korea, right? That is the biggest economic story globally once you get out of the U.S. We think that growth is going to be 4.5% to 5% next year as the pandemic begins to unwind And that consumer story of this emerging middle class in the emerging markets continues to explode. Not big here, but what does that mean? You've got huge growth in the EM, you've got really great growth in the United States, not as good as last year, but continue to be good. And a slowing, not recessionary, but a slowing trend in Europe. If you're gonna place a dollar bet, we'd say large cap, value, US stocks are the best. EM, maybe number 2, if you understand the risks there. Europe is a little less exciting to us, but why do we see so much money flowing to housing and cryptocurrency? And not gold. Is that there's a lot of money looking for a return. And that's really where you found it. In the United States, in real assets. Secondarily, in the stock market, S&P was up 27% last year. And guess what? That's kind of in line with the returns we saw in many houses, right? Stock market and housing market are behaving pretty similarly recently, and I think that is a function of consumer demand, which gets us to emotions. Quick show of hands. How many of you in the room, if I were to ask you this question, in the next 6 months, how many of you in the room think the stock market is going to go up from where it is today? It's going to be higher. Okay, so you're bullish, okay? And how many think it's going to kind of be neutral, maybe sort of doesn't do much? 2. How many think it's going to go down? You're bearish. A couple of bears in the sun, okay. You're probably right. No, I'm not, just my prediction. Here's my point. I'm referencing an incredible survey. It's been done for 37 years by the American Association of Individual Investors. This is not a group of professional money managers. This is all of us in the room. They do this exact survey every Wednesday. They say in the next 6 months, you're bullish, bearish, or neutral. They have an incredible power of contrarian indicators, okay? And here's my key point. In December, for the first 3 weeks of December, the percent of bulls in that question was below 30%. And of all respondents, less than 30% of them were bullish in the first 3 weeks. We got as low as 22% in 1 week in December, which means, in simple terms, that 78% of this group, 25,000 large, this is a weekly survey for 37 years, 78% are sort of like, I'm bearish, or I don't really know, I'm neutral. What's interesting is there is some predictive power in that. When bulls come in at under 30%, make sense? When you kind of washed out bullishness, the stock market is up like 89% of the time by an average of 15% in the next 12 months. And just 2 weeks ago, we were in that state. And all of a sudden, we've had this big sand around, and 2/3 of the room today is bullish. Guess what happens? If you get to like 70% bullish, you're not quite there in this room. You get to 70% bullish, it's probably time to take some chips off the table. Our key point on that is that, generally speaking, the individual investor in the United States has been incredibly reticent through the pandemic. I mean, they've been bearish, candidly, since 2008, 9, which is going to be kind of a long memory. But the pandemic started a really bearish sentiment period. The fear of inflation has started a massive sentiment issue. People have left, they just haven't bought stocks. They've bought houses, right? I can see it, I can hold it, I got a key to it, I can go to it, whatever. The point is, this is actually quite constructive for the year ahead. So in very simple terms, if the slide that I can't show working, you'd see that our forecast for the S&P this year is 4,900. You think, well, that's not a big deal. That's like 2.5% from where we closed yesterday, right? And our key is this, it gets harder from here. We've had unbelievable returns in the last, say, 18 months, 15 months of this market. We do think we get to 5,200 in the stock market in 2022. That this sentiment thing I just talked about, people aren't that bullish, which means the stock market's going to go up. And you've got fundamentals that continue to get better. You've got a real economy that's growing as well as we've seen, minus last year, in the last, say, 15 years. You've got fundamental, strong balance sheets at the corporate and consumer level. Housing supportive. You see sentiment there is pretty bullish. This bakes a story of optimism for 2022, but you should be rational about it. And we would just say manage expectations. The runway we've had in the last 18 months, really in the last 5 years, is not unprecedented, but it's heavy. And so the return rate gets harder. Maybe this explains some of this idea that, hey, we're not going to be up 20% in housing prices. We're going to be maybe up 5.5, 6, maybe 10, depending on the locale. The same is true for the stock market. Same is true for the bond market. In fact, in our key point, I mean, for bond investors, different than housing, related to housing. For bond investors, it's a really, really difficult period to get excited about investing money in a 10-year treasury. I'll lend the government my money for 10 years and make 1.6% per annum. But wait a minute, inflation's like at 3.2, 3.3, if we're right. I'm losing money just by trying to be safe. And so there continues to be this demand for, I'm bearish on the market, but I'm bullish on housing. Where can I find investment vehicles that can earn me a return ahead of inflation and keep us in the game as this pandemic unwinds? We begin to get back to something resembling normal, okay? So think about it simply. Economy, strong. I mean, great. It's great. Not super great, but it's great. Earnings continue to grow. And the cyclical companies, we think are going to show the strongest quality of earnings growth and responses here in 2022 on the heels of a good economy. Europe and the emerging markets, we can get into that if you want, but we're less attracted there than we are in the United States. And people continue to be skeptical, although this room's super bullish, and you should be, because you've had an unbelievable couple of years. Keep up the great work. Thank you for having me, and may the markets be with you. Any questions? Yes, sir.
You have kind of dodged the international situation where Russia is kind of piling up on the Ukraine border.
Yeah.
That would be considered, what, a black swan event if they invade, or what happens then?
It's a great question. A little bit outside my expertise level. I mean, here's what I would share with you over the last 100 years, right? We could do the litany of disaster with regards to the economy and the investment landscape as a function of things like Russia piling up on Ukraine. It's not immaterial. I think the energy price risk to Europe with what's happening there is, we've already seen it kind of, the market's already reacted. If you look at like natural gas prices in Europe, they're up 4 or 5 times. I don't know how much of that's related to this potential threat of an invasion of Ukraine, but that major gas line goes right through there that supplies 90% of Europe's heating. So there's a lot to be concerned about, and I don't want to downplay it. But the other thing is, from the bigger story is, if you get a black swan event like this, depends how the rest of the world decides to respond to it. But we can go through the fall of France, Kennedy's assassination, 9/11, the oil embargo of the 70s, and I could show you just sort of, in the grand scheme of things, super scary and massive in the moment, almost non-events in the bigger picture when you get beyond it. And I think, to be completely humble on this, that the market tends to know better than we do individually. And if that was a real risk, meaningful risk, from the economic or investment landscape standpoint, I think the market would be discounting, honestly. I think you would see major volatility in the European markets, major volatility in China and Russia. We don't see it, we've had a little bit lately, but nothing that would indicate that the market is seeing something that would really derail what I just described. Could be wrong, it could come. Maybe there's some, new development that needs to happen where a reaction like that would take place, but we're here, you're asking about it, so it's sort of common knowledge. We know that there's this buildup of troops at the border, not to downplay it, and that's a localized, very scary situation. But if there was implications more broadly, I think the market would be telling us sending us different signals than we're getting. That it's fair. But I could ask about that and maybe come back to see what our folks are saying near term. Any other questions? It's a real privilege to be with you. Yes, sir.
I'm more concerned about China.
Yeah.
Will there be a trend towards moving away from manufacturing China into other sources, hopefully United States?
It's interesting. We started to see that happen a little bit already. We've seen some onshoring of production, or at least re-hemisphering, if you will, of production, through just companies getting caught off guard. This idea of total in-time supply chain, right? Just-in-time supply chain clearly showed its weaknesses with the pandemic. And you had 65 ships off of Long Beach a couple months ago, just waiting to be unloaded for like 2 months. So we've started to see companies make some decisions to come back to that. The reality is, this administration, I think, is actually more China-friendly. One of the thoughts going into last year's election was if the prior administration had re-elected, there was much greater risk of trade conflict, right? They were talking about America first and sort of anti-China. That's really dialed down, and in our view, from just an international trade perspective, things probably are more reflective of the pandemic challenges more than a sort of a country-to-country, geopolitical trade situation. That we think is kind of calm. That heat's kind of been lowered this year. But the trend is, I don't think we see a wholesale exit of China. It's just too expensive. And I think You know, China is imposing tariffs on companies that want to leave the border, right? They're charging these excise taxes for companies that are located. You want to move your factory now, you want to leave to India, we're going to impose a pretty big fine or fee or excise tax for you to get out. So there's a disincentive to move. Some's happening. I think on the margin, you're going to see some of the stuff move back towards stateside or certainly Western Hemisphere side. That's not all bad, actually. That could actually help, in essence, in this employment issue we've got. You know, one of these good stats on that, this has nothing really to do with China, but we had a PM who wanted to look at the effect of labor force from a pandemic. Okay? So he went back and he looked at like 200 years of regional and global pandemic events. And I have no idea how we actually got this data, but in every single pandemic, the labor force coming out of the pandemic was smaller. This is going to have a death, but it was smaller than it was going in. And it took about half a generation for the labor force to fully recover in size after every pandemic. So what's interesting, when you see all this stuff about the jolts, the quit rates, and we got all these open jobs, I mean, I don't know how to totally interpret this other than it's fully in line and consistent with what's happened historically in events like we are experiencing now, going back centuries. So, not a surprise, people decide not to go back to work or they look for better wages. Our view is that this is consistent. There's some structural issues we got to deal with. Some of that onshoring from China may address some of it, but it remains to be seen. Great question. Folks, good to be with you all. Thank you for having me this morning. Great to meet you guys. Wonderful. And I'm excited about the housing market 2026. Thanks very much.
Thanks everybody for coming. We're a little past 9:20 right now, so we can get out of here. But just wanted to plug. We just heard how great remodeling is and how we need new homes. Wanted to plug our big events, our public home tours and parade of homes. We have a spring remodelers home tour May 14th and 15th. And we encourage all the remodelers to think about what projects they want to enter. Contact me, please. And then we also have the new home event, the Parade of Homes. That'll be June 24th, 25th, and 26th. So we already have some homes lined up for both of those, and we hope you can participate. Thanks very much. Everybody have a good week. Thank you.
Good luck to you.
You know, it's all right. What that is really a screenshot. Because I think our thank you very much. Great to meet you. I think our PowerPoint
You were really engaging. A lot of information, so I didn't want to distract.
No, it's great. I didn't mean to. You're good. Thank you very, very